Investment Report, ScanTech AI Systems, Inc., ticker, STAI Executive Summary and Investment Thesis, Core Business Overview. ScanTech AI is a small security technology company specializing in fixed gantry computed tomography, CT scanning systems used for threat detection. Its products integrate artificial intelligence and machine learning to identify hazardous materials and contraband. Target markets include airports, ports, nuclear facilities, borders, and critical commercial or governmental infrastructure. Investment recommendation, 12-month view. Strong sell bull case, the company has started generating revenue, roughly $0.9 million over the past 12 months, marking progress from prior years with no revenue. A large portion of legacy debt, around $30 million, has been converted to equity. It's partially cleaning up the balance sheet. Deliveries to nuclear facilities in Canada and progress on certifications suggest early signs of traction. Successful regulatory approvals could open much larger markets. Bear case financials remain deeply negative. Large losses, weak liquidity, and a working capital deficit raise going concern risks. Revenue base is extremely small compared to operating costs and cash burn. Debt remains a significant burden. Equity is negative, and current liabilities far exceed current assets. Dilution risk is high. Regulatory execution and competitive risks are severe. Established players dominate the sector with strong customer relationships and certifications. Business overview operations and products, fixed gantry, CT scanners for non-intrusive screening, AI-driven software platforms to enhance detection capabilities. After sales, services, and support tied to deployed systems, segments and geography, revenue primarily from product sales and initial service offerings. Headquartered in the U.S., but has delivered systems in Canada, customer base. Government and high-security markets, airports, nuclear facilities, customs, and industrial security infrastructure. Industry and competitive positioning. Industry landscape. Security screening is a heavily regulated and mission-critical sector. Incumbents like Rapiscan, Smiths Detection, and L3Harris already dominate with certification advantages and global service networks. Growth drivers. Rising global demand for advanced threat detection. Government regulations pushing higher screening standards. AI integration offering efficiency and accuracy improvements. Headwinds. Lengthy and costly certification processes. Long procurement cycles in government and regulated sectors. Reliability and maintenance concerns could slow adoption. Competitive position. Limited moat relative to established incumbents. Technology offers novelty, but competitors have entrenched relationships and resources. Financial analysis, trend overview, TTM latest filings, metric value notes, revenue $907,000 first meaningful revenues, up from near zero. Net income $9 million losses. Narrowing slightly, but still large. EBITDA approximately $12.5 million, operating expenses overwhelm revenues. Gross margin approximately 24% positive, but scale is too small to cover costs. Operating and net margin deeply negative, reflects high G&A and legal costs. Balance sheet and health cash. $0.77 million, very limited liquidity. Working capital, significant deficit. Current liabilities far exceed current assets. Debt and equity. Debt still heavy. Equity negative even after conversions. Free cash flow. Roughly $9 million TTM, unsustainable without new financing. ROE efficiency. Negative returns, very low asset turnover. Valuation. Metric current peer context, commentary, PETTMNA. Losses peers approximately 15 to 30, when profitable, no PE, until profitability. Forward PE, not meaningful growth peers, trade higher, dependent on contract wins. Price sales extremely high, greater than 100. Peers approximately 5 to 20 implies very high expectations. EV/EBITDA, negative peers approximately 10 to 20 times losses make comparison invalid. P/B not meaningful negative equity. Peers greater than 1 times negative book value is a red flag. Dividend yield none rare in this industry stage, no shareholder return. Valuation is driven entirely by speculative expectations of future adoption and contracts rather than fundamentals. Risk assessment, key risks, liquidity risk. Cash reserves extremely limited. Burn rate unsustainable. Dilution risk, high likelihood of equity raises or further debt conversions. Regulatory risk, delays or failures in obtaining key certifications, for example, TSA or international standards. Execution risk, unproven ability to scale operations and service. Competition, incumbents dominate the market with established infrastructure. Market listing risk, potential NASDAQ compliance issues due to market cap or share price. Upcoming catalyst certification milestones, for example, a PSS 6.2 compliance. Large airport or government contracts. Further product deployments or service agreements. Debt restructuring or new financing terms. Quarterly filings showing revenue growth or cost control improvements. Conclusion recommendation. Strong sell supporting bear case points. Very weak financial position. Small revenue. Persistent heavy losses, negative equity, and working capital deficits. Cash runway is short, forcing reliance on new financing. Valuation detached from fundamentals, pricing in success that is far from certain. Bull case triggers to monitor regulatory approval milestones. Major contract wins in government aviation sectors. Proved cash management and reduction in operating costs. Final note, this company remains speculative. Unless near-term catalysts, certifications, contracts, financing stability materialize, downside risk dominates. Investors should closely monitor filings, liquidity disclosures, and regulatory progress before making any decision.